Hello, everyone. Welcome back to the Weekend Charts. Charlie Bilello here. Another big show for you this week. If you're watching this on YouTube, take a moment, hit that subscribe button, hit that like button, leave us a comment. Love to see all the comments of late, so keep them coming, definitely. What are we going to be discussing today? A lot of important topics going on in markets. We're going to start out with earnings, expectations, digging into a couple of examples there, some cash generating machines, talking about Google and Microsoft. We got a new GDP report for the first quarter, so I'm going to dig into that. We're going to be talking about the Fed latest expectations. We got some new inflation data, a sentiment check on the market. Warren Buffett, he has a lesson on playing offense. We'll talk about that. Affordability in the housing market remains a big issue. It's not getting any better. And we're going to end, as we always do, with something positive. That's higher real yields on your long-term bond investments. Number one, expectations are everything. And when you're coming into earnings season, all that matters really is that expectation coming in. If expectations are very, very low, it doesn't take much to exceed that, and you typically see the stock rally. If expectations are very, very high, any disappointment off of that in terms of the earnings number, and you see the stock fall. And we have two perfect examples this week of this. One where expectations were extremely low, that would be Tesla, down 64% entering earnings from its all-time high. Huge drawdown, really diverging from the other Magnificent Seven names. And we talked about the reasons for that, and the reasons really were evident in the earnings report here. You had revenue growth down 9% year over year. That was the biggest decline in revenues for Tesla since 2012. So yeah, you're talking about 12 years since we've seen a growth number this low, negative 9% growth. Of course, we're used to seeing Tesla growing significantly on the upside. Now a negative quarter on the downside. Net income being hit hard over the past year, down 55% to 1.1 billion. And margin compression, we've been talking about this, but the trend really continues here. 17% now gross profit margin, down from 29% 2 years ago. So if you just look at these numbers, you would say absolutely horrible report based on the fundamental numbers. What does the stock do in after hours trading? It's, of course, spikes higher, up 13%, and it's actually continued to rally since then. So what's going on here? Well, investors are looking for any bit of positive news in terms of that earnings release and the call after, and they got that in terms of what Musk was saying about new affordable EVs. He's saying that's going to happen quicker than people were expecting. They're going to start producing these new models in early 2025, if not late this year. So will that ultimately help the bottom line? We don't know yet, but optimism over that. And I would say also this idea that Tesla is going to start licensing its driver assistance systems to other automakers. So another potential revenue generator there. Obviously, a lot of optimism about the self-driving capabilities of Tesla. And if they can license that out to other automakers, obviously that would be a benefit again. But biggest story is the expectations coming in. And we saw just how low they were by the fact that the stock was able to go up this much despite reporting what seemingly looks like really awful fundamental numbers. So market looking ahead, obviously, to better numbers, and a lot of negativity was priced into the stock. Opposite end of the spectrum, I would say, is Meta, who reported earnings this week as well. You had the stock up 138% before they reported earnings. So just a huge amount of optimism heading into the report. And report, by all accounts, pretty good here. We're looking at revenue growth up 27% year over year, highest in a few years. You had net income up 117%, huge growth over the past year. Operating margins moved up to 38% from 25% a year ago, and Meta cutting costs here, which the market obviously loved this last year in terms of the stock price rally, and that's continued year to date, is that 10% reduction in headcount, driving that with employees now down to 69,000. So all of these things moving in the right direction for Meta. How did the stock react to the report? It was down 15%. So complete opposite to Tesla. A lot of optimism heading into the report. And what you saw is the stock actually go down. And number of reasons people were pointing to us. And again, when the stock is up that much over the past year, anything that's perceived as negative can push it lower. And what investors saw was the guidance from Meta was below expectations. So they're saying 37.75 billion for the second quarter, and analysts were expecting 38.3. So not a huge number below that average estimate, but nonetheless, they're saying that that was the reason for the sell-off. We don't really know, but I would say the number one reason is expectations were just so high heading into it. And I think there's also some concern about Meta's continuing to lose money on this Reality Labs division, and the losses here are just piling up. It's really incredible. I don't think we've ever seen this for a company in terms of the losses totaling 46 billion now in this Reality Labs division since they started reporting this at the end of 2020. Just a stunning cumulative loss. Obviously, Meta continuing to pour money in this, believes ultimately it's going to make money, but losing $3 to $4 billion every single quarter, not a small amount. And it's amazing that they're able to generate the net income that they can even with this huge loss. Just shows you how profitable their core business has been. Speaking of profitable, speaking of cash generating machines, we definitely have two of them reporting this week in Google and Microsoft. And if we look at Google and Microsoft, they're actually number 2 and number 3 in terms of Microsoft being number 2, Google number 3 in terms of operating cash flows over the last 12 months. Both of them over 100 billion in terms of trailing 12-month operating cash flows, just enormous cash generating machines. Only Apple is higher in terms of generating that much cash. And if we look at cash on the balance sheet, Google leads all companies cash less debt, almost 100 billion on its balance sheet. Just an incredible number. And what we got out of the earnings from Google, beating expectations, I think by a handy margin, both in terms of the top line and the bottom line. You had revenues up 15% over the past year, highest we've seen in a few years, and net income up 57% year over year to a new record high, 23.7 billion. So just minting money, operating margins expanding up to 32% from 25% a year ago. And Google has so much money on their balance sheet. There's so much money in terms of cash flow generation that they actually announced for the first time a dividend per share here, 20 cents per share. Not a huge amount, but interesting to see Google joining Meta, which announced last quarter that they were going to start paying a dividend in terms of starting this dividend program. And they also announced, not a small number here, authorized the company to repurchase an additional $70 billion of its stock. So a lot of excitement over these two things. Obviously, the growth being the number one thing in terms of beating on the top and the bottom line. But the stock reaction, just enormous, up 10% since reporting earnings to a new all-time high. And Google, of course, was struggling not that long ago. Well, now it's come all the way back and far exceeded that previous high from 2021. So if we're looking at Google revenues over the last 20 years, it went public 20 years ago in 2004. You had $3 billion in revenue back then, and just stunning, continued compounding this growth over time. It's actually now 100x higher, the expected revenue for this year versus their IPO year in 2004. Very few companies in history have ever done this over a 20-year period. Google really standing out among all of these other companies in terms of this type of growth. So it's just enormous, and it's still growing. That's the most amazing part to me, is it's at 300 billion and it's still growing north of 10%, or expected to, for this year. So number 2 example, cash generating machine, would be Microsoft. Revenues up 17% year over year, a little bit of a deceleration from last quarter, but it's just still enormous growth. The bottom line increasing more than the top line, 20% year over year, second highest quarter in terms of net income, 21.9 billion, and margins, like Google, expanding up to 45% operating margins from 42% a year ago. Stock reacted not as good as Google, but pretty good, up 2%, a little over 2% since reporting earnings. And you can see it's just had an incredible run over the last year. So Microsoft doing extremely well over the last decade. We're talking about over 10x growth in its share price. And a lot of that's being driven, of course, by profits, but you also have the fact that Microsoft, in terms of multiple, trading at a much higher multiple in terms of revenues and in terms of earnings. So investors still very, very optimistic about the future growth prospects of Microsoft, which is pretty incredible to see given how much it's grown over the last decade. So we got to discuss the GDP report. A little bit of a disappointment here. Came in below expectations. We saw the consensus estimate was at 2.3%. That's the quarterly annualized number. And it actually came in at 1.6%. So a good deal below expectations. And definitely now showing a deceleration of growth. So the quarter before, we had 3.4%. So now down to 1.6%. And you can see here, that's the lowest quarter we've seen since 2022 when we actually had two consecutive negative quarters. Not huge numbers, but we were talking back then about potential recession. Didn't end up happening, but here we are, slowest growth since 2022. And I think that even the more concerning part was the fact that we got another confirmation that inflation seems to be moving back in the wrong direction. We saw the price index for GDP move up to 3.1% in the first quarter, and that compares with a 1.9% increase in the fourth quarter. So slower growth, higher inflation. And if we break down the number, what are we seeing here in terms of the contributions? Where is the growth coming from? Consumer spending on services continues to be the big area. You're just seeing consumers continue to spend on services. Goods, not so much. You can see here actually pulling back in negative territory for the first quarter. So that actually detracted from GDP. We also saw net exports be a detractor here, probably not in a small part due to the rise in the US dollar, which is making US goods more expensive. So in terms of the report here, I'd say it's more in line with what we've seen in the previous decade in terms of the growth rate. We had been seeing, I'd say, above average growth in the past 2 quarters prior, and now we're getting back to where we were before. If we look at the economic expansion now, so we have continued expansion in the first quarter. It's now actually, it's hard to believe, 4 years in terms of the expansion starting in April 2020 at the lows after the COVID crash and collapse in GDP. We now have 48 consecutive months, 4 years of growth. Annualized real GDP during that period, 4.6%. You can see well above average, but that number is really reflecting the recovery from that COVID drop. So we're measuring it from here, looking at 4.6% annualized. If we look at just like the last 10 years of real GDP, up 27%, so 2.4% annualized. So we pretty much, let's say if COVID didn't happen and we continued on a trend line, we're pretty much continuing the growth rate that we had the 5 years before that, which is about 2.4%. And now we've grown 2.4% as well. We just had that big dip in terms of COVID, and thankfully we're recovering and still hitting new highs. So more realistic growth expectations. You could see economists are almost always wrong, but they're expecting growth to still be moderating here in the next few quarters. We'll see if that actually happens or not. But I think a more realistic long-term expectation is that 2 to 3% range. That's what we've been seeing. I don't see any reason to believe that the numbers are going to be significantly higher than that, let's say, over the next decade. So if we're looking at the Fed, what is going to be the reaction to this GDP report? Higher inflation showing there. And we got new numbers in terms of PCE, which is the Fed's preferred measure of inflation, particularly core PCE. And core PCE did not come down as much as expected. It stayed at 2.8%, same as last month. People were expecting it to come down to 2.7%, so a little bit of disappointment there. Same thing with the overall PCE. The expectation was a drop to 2.6%. Came in at 2.7%, which is actually the highest we've seen since October 2023. So like overall CPI, we're seeing PCE move back higher after a move lower for most of last year. And one of the drivers of overall PCE we're looking at is going to be energy prices. And if we look at the average price of gas it's moving up again. So 3.79 a gallon. That's the highest. That's the national average, highest since October 2023. That's likely going to continue to push CPI up for the month of April. And what the Cleveland Fed is saying here is that the expectation should be around 40 basis points, so 0.4% for the month of April, and that should bring CPI up to 3.5% over the last year. So essentially unchanged versus last month, and obviously not moving closer to that 2% Fed objective. So we'll see where it comes in, but there shouldn't be a big expectation that CPI is going to just drop dramatically for the month of April. Seems like it's going to be flat looking at the year over year versus the prior month. And this is a little bit of a concern. I don't want to read too much into it yet, but we had been pointing to the money supply decline as a reason to expect lower inflation. This is a leading indicator of inflation. We saw that in terms of the way up here, this huge money printing, unprecedented, that we had in 2020 and 2021. Then the inflation came after that. Then we had that huge deceleration where the money supply actually contracted, biggest contraction on record with data going back to 1960. Now we have it starting to move back in the direction of expansion again. We're not quite there yet, still down year over year, down 0.3%. That was the 16th consecutive year over year decline, but that was the smallest decline that we've seen. And it seems likely that's going to go into positive territory when we get data for next month. So we got to watch this closely. As I said, if this just stays flat, that's I think a very good thing for another year or two to help digest this huge money printing that we did. You don't want to see, if you're worried about inflation, this to start to spike higher again. Again, it's just 1 month. I wouldn't read too much into it, but definitely something to watch here in the coming months. So what happened in terms of Fed expectations this week after that GDP report, after the PCE report? What we saw is another move higher in terms of the expectation. So that higher for longer is becoming higher for longer. And we're now looking at, in terms of the expectations, a year-end Fed funds rate of around 5%, which would imply really just one Fed funds rate cut this year. And if we look at the probabilities for December here, you could see that's where it is. We're at 500 to 525 basis points, which would mean just one Fed cut this year. Remember, entering the year, the market was pricing in 6 to 7 rate cuts this year. So what a huge shift in only 4 months that we've seen in terms of market participants. Even a month ago, the market was still expecting 3 rate cuts this year, if we're looking at the median expectation here. And today, again, just one rate cut. When are they expecting that cut to come? As of now, September. And again, market saying that's the only cut this year. It's going to hold in the May meeting. That's coming next week. Hold in June, hold in July, do that cut in September, and then hold for the last 2 months. We'll see what happens. Obviously, a lot of data between now and then, but I think really this week solidified the fact that the Fed really will not have the data they need to cut rates in June. So take that June cut, I think, completely off the table, given the data that we got this week. Okay. So if you're an investor, business owner, and you're thinking about the years to come, you're worried about the economy, worried about where the market is heading, we could help you with all that creative planning. So reach out. We're in all 50 states. We probably have a location near you. Over 300 billion in assets under management and advisement. And go to the website, creativeplanning.com/Charlie. Set up a 15-minute call. Get a second review on your portfolio. We're here to help. And I'll have a link to the show notes as well for you to click on and schedule that 15-minute intro call. So sentiment check on the market. I promised last week we would show what happened in terms of sentiment after that pullback. What I said is what we want to see is more people shifting to bears, to neutral, than bullish. So we had that extreme bullish sentiment in March that we talked about. And with that 5.5% pullback, we want to see, well, did that impact market participants? Well, here's what we're actually seeing here. So far, it's had a decent impact here in both the AAII poll and the active manager exposure sentiment gauge. So if we're looking at the AAII poll for the first time this year, we're actually seeing the number of bears exceed the number of bulls. So first time this year, and it only took 5.5-6% pullback to get the number of bears to exceed the number of bulls. That's a good sign. Now I would just say sentiment is neutral. And if we look at the active manager exposures, they were negative. They were leveraged long, so over 100% long equities in late March when the S&P 500 was at all-time highs. And after a 5.5-6% pullback, they've reduced that exposure to 63%. So not negative sentiment, not super bearish sentiment, kind of what you would expect. I'd say a good sign. Now we're just in neutral territory. So definitely not a signal. It would have to go down, I think, much more, the market, to push people in terms of being extreme bearish like they were last October after that 10% correction. But a good sign to see people getting a little bit pessimistic here, a little bit cautious and worrisome about the rise in interest rates, about the inflation, about the conflict with Israel and Iran, all of these factors causing people to be a little bit more skeptical. That's definitely a good thing. You want to see that happen when the market pulls back. You didn't want to see people say, no, we're going to continue to be bullish here. So good sign. Now we're in neutral territory. Can't read anything from being neutral. Sentiment only an indicator at extremes. You had that extreme in March in terms of people being overly bullish on a number of indicators. And we had it in the opposite direction last October. But most of the time, sentiment data is just noise. So we'll watch this over the next few weeks to see, as the market moves up and down, what the reaction is in terms of sentiment. So I want to talk about Warren Buffett here and a lesson he has on playing offense. Here's a quote from one of his annual letters where he said, "Having loads of liquidity lets us sleep well. Moreover, during the episodes of financial chaos that occasionally erupt in our economy, we will be equipped both financially and emotionally to play offense while others scramble for survival." So what is he saying here? He's saying we have to have cash on the balance sheet just in case there's an opportunity. So when there's a lot of fear, we're talking about in terms of 2022 is the last bear market. Well, if you have cash on the balance sheet, well, now you can deploy that and an opportunity. In 2008, of course, Berkshire was very, very aggressive in buying during that period of fear and panic. And Buffett actually penned an op-ed in October of that year saying, "Buy American, I am." So are we at that stage today? Very much not. Of course, we hit over 20 all-time highs in the first quarter of this year. And if we look at Berkshire's cash pile at the end of that period here, we're looking at $168 billion in cash. And here I'm including cash equivalents, and treasury bills in terms of Berkshire Hathaway. That's a record high. And you can see the increase since 2010 in terms of cash on their balance sheet, just obviously enormous. And you can see this dip here where cash went down. They actually deployed some capital. That was during that 2022 bear market. And since then, just replenishing that cash pile and obviously waiting, sleeping well at night and waiting for that opportunity to come again. Now, Berkshire has the benefit, of course, of waiting as long as they want. Right now, they're earning over 5% on this money in terms of treasury bills for the time being. And so it's going to be very patient. That's just the Warren Buffett way. And why are they holding such a high level of cash here? I'd say it comes back to valuations. Warren Buffett's a value investor. And if you look at the CAPE ratio on the S&P 500, which smooths earnings over a 10-year period, it has a CAPE ratio today of 34. And we're looking at a long-term average around 17. So stocks certainly not cheap, not as expensive as they were back in 2021, certainly not as expensive as they were back in 2000 during the dot-com bubble peak, but definitely not cheap on a historical basis. And probably, I'm guessing here, that they're waiting for that opportunity to start to deploy some of this cash. And as an investor, you have to be thinking about that in terms of your own portfolio. Is it a time to be super aggressive, or is it a time to be a little bit more skeptical? And when this valuation level gets elevated here, let's say it continues to go higher, you want to be more skeptical with each move higher. And if you have cash, you want to be deploying it in periods like 2022 when there's more opportunity in the market. So can't afford the home they're living in. This was an interesting poll. We've been talking about this concept, but Redfin really quantified it with this poll that they had last week, asking people, if you were looking to purchase a home, do you think you could afford a home like yours today in your neighborhood? So essentially, all of the people that have bought homes in recent years, they bought them at much lower prices, many of them, and they often times bought them with much lower mortgage rates, or they refinanced and they have a lower mortgage payment because of it. And if you look at the results of the poll, very interesting here, and I think this explains a lot in terms of the supply in the housing market, is the fact that 38% of people said definitely not or probably not can't afford that home that they're living in today. So if they had to go out, buy it today at over 7% interest rates at current prices, they couldn't do it today. And if you add in might or might not be able to afford it, we're up to 58%. So more than half of people are questioning whether they could afford that home today. And what's the big driver of that? Well, number one would be that mortgage rate. If you look at a few years ago, we were at below 3%. We are at all-time lows, which were 2.65% in terms of 30-year mortgage. This week, we moved up to 7.17%. That's the highest level we've seen this year. And of course, since most people finance the cost of a home, this is going to increase your monthly payment. If it was just the mortgage rate, as we talked about, that would be problematic. But it's not just the mortgage rate. It's the fact that home prices have continued to go up in this period when the mortgage rates are rising. So you have the double whammy, higher financing costs and higher purchase price. And what that's leading to is a record high in terms of that monthly payment that you would need. So we're looking at 13% increase over the last year, another record high this week in terms of the monthly payment you would need to afford the median priced home for sale. We're at 2840 now, and 4 years ago we were at 1480 in terms of that monthly payment. That's a 92% increase. So what is this impact on the housing market? It's enormous. Of course, let's start with the people who haven't bought a home, looking to buy a home. Well, oftentimes it's unaffordable based on their income today because of this huge increase in the payment, because people's incomes haven't gone up 90% in the last 4 years. And then you have the fact that prices are so elevated. Why they're so still elevated if it's unaffordable? Well, it's that locked in concept. It's the fact that these people are saying, I can't afford to go out and buy a new home, so I'm not moving. And if they're looking to trade up, same problem that they have. So these people are not listing their homes for sale. That's created a massive supply shortage, which has kept prices up. And really, what we've been saying is it's hard to envision unless one of these two factors changes, either prices come down or mortgage rates comes down, that you're going to see a change in the dynamics for the housing market. So we'll have to see which direction this eventually breaks. But for now, the housing market's kind of still in a standstill because of this this feature that's going on with higher prices and higher financing cost, really a double whammy for homeowners. So I want to end, as we always do, with something positive. That would be higher real yields. What's a real yield? It's simply taking the nominal yield that you're getting on a bond and subtracting the rate of expected inflation. And what we're looking at here is the 10-year treasury yield moving up to 4.7% this week, highest since last November. Started the year at 388, so significantly higher than the start of the year. And that bottom panel here, really important. This is the 10-year, taking that 10-year yield and subtracting expected inflation over the next 10 years. And they're highest also since last November at 2.28%. So what you're seeing here, if you're a bond investor, you're getting way more than you did, let's say, in this period since the start of 2012. Average was around 2.3% nominal. You're more than double that. And if we're looking at the real yield, you're looking at a huge increase since 2012. The average has been 0.3%, and we've seen it go negative in 2020. It was negative back in 2012 and 2013 as well. And now you're getting a positive inflation adjusted yield, 2.3%, which pretty good in terms of the last decade. Certainly much better than where we were a decade ago. And why is this important for bond investors? We know bond investors have been crushed, still in a bear market. Been a very difficult transition from this all-time low in the 10-year of 50 basis points in 2020. Now we're over 4% higher than that in terms of the 10-year yield. That transition has led to the longest and deepest bear market in history for the bond market. The good news, once again, is that if you're a bond market investor today, so forget about the last few years, if you're coming in today, you're likely to get a much higher return going forward. And the reason for that is there's a 97% correlation between that starting yield, so the starting 10-year yield, which is now 4.7%, and what your forward 7-year return has been in the past. So 97% correlation, extremely high, highly predictive of better future returns. We're now in the fourth decile historically. When the 10 years been in this range, we're looking at around 5% return for bonds per year over the next 7 years. What's going to happen in the next year? No one knows. If that interest rate continues to rise, we go to 5.5%, you're going to have losses on your bonds. But over that 7-year period, if you hold up bonds to their duration, you're going to likely achieve around 5% per year, which is going to be much, much better than we've seen in recent years, which has been obviously negative returns. And those ultra low bond yields that we saw in 2020 were on a nominal and real basis, will now completely different ballpark today. So if you're a long-term bond investor, we talked about cash last week. If you're a longer-term bond investor and want to lock in these higher yields today, the good news is you're seeing the best returns that you've seen really since 2007 or so. So it's been a long time since you can lock in close to 5% yields on longer-term bonds. And anyone with bonds and thinking about bonds, having some bonds in your portfolio, this is obviously good news. And that inflation picture, very good news. The fact that you're being compensated for that inflation where you haven't been in a long time. So we'll end it right there. Thanks everyone for watching. If you're watching this on YouTube, hit that subscribe button, leave a comment. I read all the comments, try to respond to as many of them as possible. Have an awesome weekend, and I'll see you next time on the Week in Charts.